Despite the fact that on Tuesday evening some Western media named not only the date but also the time of a possible invasion into Ukraine, there was no escalation at the Ukrainian-Russian border. Instead, this news calmed global markets to some extent. The excitement subsided and trading instruments moved to their usual price levels. Political risks, which drove oil prices to record highs, also contributed to a decline in the oil market. It's logical to assume that with no signs of escalating tensions, oil quotes have every chance of sliding to at least $90 per barrel. However, the risk of energy disruptions remains. There's not yet clear decision on further relations between Russia and Ukraine. Any political jitters will continue to rattle markets until the parties reach agreements. This means that a further oil price rally cannot yet be ruled out. From a technical point of view, Brent crude oil futures pulled back slightly from the local high of their upward cycle. As a result, the quote returned to the level of $93 per barrel. Despite the correction, market sentiment is still mainly bullish. If the price rises above $96 per barrel again, oil will most likely resume the uptrend. As you know, no news is good news. Against this background, the ruble advanced. The Russian currency managed to recoup some of its early losses for the first time since February 11. The dollar-ruble pair approached the level of 75 rubles per dollar. With no fresh political risks, the situation is likely to return to normal, and other factors will come to the fore. In particular, one of these factors is the interest rate disparity, which may support the Russian currency. In the meantime, the focus of market participants is still on political issues rather than on macroeconomic indicators. That's why it's rather difficult to predict the pair's further movement. The trading instrument is extremely vulnerable to any news on the Russia-Ukraine conflict. In case of careless statements and further aggravation of the situation, the dollar may gain value. Following a strong rally, the dollar-ruble pair showed similar dynamics in the opposite direction. Thus, it can be concluded that the nature of the movement is purely speculative and is based on fundamental factors. Probably such price swings will continue in the near future. Thus, traders are recommended to keep monitoring news reports. As for technical analysis, it's worth focusing on the local overbought and oversold areas of the assets. This will help determine the beginning of a technical correction after sharp price fluctuations. The gold market responded negatively to easing geopolitical worries as expected. Traders stopped fleeing to safe haven assets. A steep rise in gold prices was replaced by a decline. Now it's quite obvious that the precious metal will extend weakness. The mark of $1,820 at which the quote started its bullish run can be seen as a target. Again, the asset's further movement depends heavily on political developments and rhetoric between the states. The lower the anxiety, the higher the likelihood that gold prices will fall. On Tuesday, gold futures entered a correction from the resistance area of $1,880 per ounce. The market is still bullish. However, in order for the metal to continue trading upwards, it needs to consolidate above the level of $1,920 per ounce on the daily chart. Until then, there is a risk that the scenario implying a rebound to the peak posted on November 16, 2021 may repeat. Well, this was the forecast from our analysts. Obviously, until the political situation returns to normal, volatility is likely to remain high. We wish you a profitable trading day and see you back soon.